James, thank you for joining us. Here we are 1 month into the new year. How did the Factor Series funds perform in January?
Well, they actually started the year 2015 pretty well. Factor 3 was up 2% net of all fees, Factor 4 up 2.4%, and Factor 5 just shy of 3% net of all fees for the month.
Behind those returns then, what were the main asset allocation drivers behind performance?
Well, they benefited from having a decent weight in the UK equity market. The UK equity market was up nearly 3% in sterling terms, in total return terms over the month. Interestingly, mid-cap actually outperformed both large cap and small cap over the month, so it's a strange dynamic there perhaps. But as you know, the funds are decently weighted to the UK market, which provided a decent driver to performance. Also, for example, positions in Europe. Europe was up nearly 8% in euro terms over the month on the back of obviously the ECB's news. Euro was weak though, so once you translate that back into sterling, you actually get a similar return to the UK market, but it's interesting that actually helped performance as well. Fixed income markets, again, benefiting from the ECB's actions. The gilt market up 5% remarkably over the month. Now, we're not heavily weighted in the gilt market in the factor funds. We think that market is expensive, but we do have a lot of credit exposure in the portfolios across a wide range of different credit strategies, and these mitigated that underweight, if you like, and provided an impetus to performance as well.
You mentioned your credit allocations there, James. A more general note on how the portfolios are positioned today.
Yeah, well, we've got a decent chunk in equity. Clearly, Factor 3's got less than 4, which has got less than 5. We've got more risk tolerance at the end of the spectrum there than we do at the bottom, so we've got more equity at the top than at the bottom. Decent weight in the decent weight in the UK, underweight the US really compared to targets, and we're taking positions instead in Europe, where we think there's better valuations, and Japan on a currency hedge basis, where we think there's better valuations as well. We do have some global managers in there, some somewhat niche players. We've got Morgan Stanley Global Brands, Copenhagen's Global All-Cap Contrarian Strategy, First State's infrastructure positions as well, and then finally we've got the iShares Gold Producers. So some global but niche-ish positions which bring an interesting complement to our total portfolio equity exposure there. On the fixed income side, we use a variety of active and passive managers, and the real drive for performance in the fixed income part is the selection of credit managers over sovereign bond names, and we're using the likes of high yield, loans, convertible debt and emerging market debt. Finally, we've got a bit of cash in the fund. We tend to keep it in sterling. It's a bit of dry powder as much as anything else, something we can put to work as and when markets weaken off a little bit and give us good valuation opportunities for us to exploit.
Thanks for that, James. Can we then just get a quick comment on your outlook?
Yeah, I mean, not much has changed over the last few months in terms of our outlook. Clearly, we've seen a bit more volatility in the markets. We've seen then the ECB act recently, and that sort of relieved people with respect to the ability of the ECB to do sovereign QE, if you like. They've done it with a vengeance, and it's almost akin to a blank check, and the markets have responded to that significantly. So you've got a world where oil's fallen, good for consumption. You've got equity markets that are not too expensive. You've got unlimited, almost certainly large amounts of further liquidity coming to the market from the likes of ECB. Likely Japan will do something more going forwards as well. So it's a broadly constructive view of the world. Not without risks though, as you know, and as a result we need to keep broadly diversified, but with a positive bent in the portfolio today.
James, thank you very much.
Thanks, Richard.